everybody, what's going on? It is Wednesday, June 2nd. Just posted my new episode of my podcast. You could check it out. The link is right here in the description below. Also, want to let you know that I'm on Apple Podcasts, Google Podcasts, and Spotify. So if you go to those things and if you search Mike Norman MMT Podcast, you'll get it. And that's great. You could subscribe and listen to it every week. So, newsflash. The Fed is taking away the punch bowl. Oh no, the Fed is taking away the punch bowl. The Fed is taking away the punch bowl. Yes. Word out today is that the Fed is going to liquidate its corporate bond portfolio. It'll do this over the course, the remainder of the year through the end of the year. And I already heard people mentioning on Twitter and commenting, oh, this is a tightening. This is a tightening. All right. Let's put this all in perspective. I think, according to one thing I read, the Fed has $13.6 billion in its portfolio. Those are corporate bonds. I know it has a corporate credit facility with like $26 billion. It also has a commercial paper facility with like $8 or $9 billion in there. So anyway, I saw this number, $13.6 billion. It's going to wind that down through the end of the year. You have to understand that there are something like 10.6 trillion in corporate bonds outstanding. All right, almost 11 trillion in corporate bonds outstanding. So what the Fed holds in its portfolio is really a minute fraction. I would be let me just mention one other thing. The real support to corporate bonds has been the fiscal programs, the fiscal support. And the reason I say this is because these, extraordinary fiscal flows that have been, happening, as I've said before, that spending, that government spending, a large percentage of that flows to corporate profits. And companies pay their debt, service their debt out of their profits primarily. I would be much more concerned. You should be much more concerned. We all should be much more concerned if there is a contraction or a reversal in those fiscal flows. That would have a negative impact on debt service much more broadly than anything we have seen with respect to, what the Fed has been targeting or supporting. So right now, everything is fine with those fiscal flows. But as you know, I've been talking about the month of June and how it may end up to be a game changer. I'm not calling it yet. I want to see the numbers, but I have been talking about the cuts in those enhanced unemployment benefits that are going to start this month. 21 states and then 2 more in July are going to be ending those benefits. And that could have a significant impact on the economy, a significant impact on these flows and then the economy, and also on the financial markets, which really haven't been paying much attention to these developments. So it's something we got to keep an eye on. So the Fed is going to wind down that portfolio. It's not a big portfolio, but I see people already talking about, it's a tightening. It's a tightening. It's not a tightening. It's going to be fine. Again, the thing we have to be focused on and the thing we have to be potentially concerned with is those fiscal flows and whether or not those benefits cuts will have a significant impact on the rate of those flows. If we see a deceleration or a contraction of any significant magnitude, that's going to be problematic for the economy. That's going to be problematic for the stock market. Let's talk about AMC. Wow, up 100% today. It's been up, I think, over 3,000% since the beginning of this year. Unbelievable. Unbelievable. And frankly, I don't know what to make of it. I really don't know what to make of it. I thought early on, when was it, back in March, when we saw all these Reddit meme stocks, and I did a couple of videos on this, I thought back then, you know, there was a case to be made for AMC. All right, we were coming back from the pandemic. It's a large movie theater chain. People were eventually going to go back to the movies. There was a huge short position there. I thought there was a bullish case to be made. And it ran up in that first spike back in March. It came all the way back down, just like GameStop, by the way. That's running up too. So these meme stocks are back in play. And I have no real comment on it. I'm just mentioning it because it's been like incredible to watch. I'm not in it, unfortunately. It's not something that I do. It's not something that I follow necessarily. But it's really been incredible. And we'll see where it goes. But it's probably a sign that we're going to get some more of these heavily shorted stocks, another one of these periods, maybe just very short in duration, where, you know, the internet kind of gangs up on these short sellers and spikes up a lot of these stocks. So really crazy, but AMC has had a huge, huge run. Let me talk a little bit about oil before we go. I've been following the futures spreads. I've been looking at the futures spreads in oil. The backwardation in crude, right? What is backwardation? When the spot month is at a premium to the deferred contracts. That backwardation has narrowed over the past month or so. And that has been happening even as the flat price, the actual price of crude, has been going up. To me, that is a weakening picture. All right, the spread is indicating that more supply is going to be coming onto the market. And we will see an OPEC output increase in July. There's also negotiations that are ongoing right now and supposedly pretty close to getting Iran back into the oil market. So those are two things to consider. We're at a 3-year price high in oil. The spreads are narrowing significantly. Producers have been, steadily shorting this market. Producers have been steadily shorting this market at levels that have been pretty consistent. I mean, they're really not pulling back very much. So something to keep an eye on. Anyway, check out my podcast. It's in the link below, and I'll see everybody tomorrow. Bye.